I'd like to welcome everybody. I'm Scott Hodge. If you don't know me, I'm President Emeritus at the Tax Foundation. Some of you have seen me for quite a few years, and now I'm in my new role. Thank you for joining us for today's webinar, where we will unveil an exciting new report from the economic team at the Tax Foundation. We honestly believe that this report will open some eyes and allow people to imagine what life would be like with a new tax code in America. A new Rasmussen poll found that 51% of American adults believe that they pay more than their fair share of taxes. And to be honest with you, they're right to feel that way. A recent study by the Paris School of Economics determined that the US tax system is more progressive and more redistributive than European tax systems. Imagine that. A French think tank determined that the US tax code is more progressive and more redistributive than European systems like Sweden's. Well, Americans also think the tax code is too complicated. A Pew Research Center survey found that 45% of Democrats and 52% of Republicans said that the complexity of the tax system bothers them a lot. And a Wallet Hub survey found that 81% of people say that the government does not spend their tax dollars wisely. Well, I think all of us all we need to do is look at the latest CBO report on the federal deficit to say that they're probably right. Americans deserve a tax system that lifts all boats, not a redistributive tax policies that leads to bloated federal government and a mountain of debt. Last year, the Tax Foundation launched an effort to set a new vision for tax policy, a vision framed around growth and opportunity. Tax policy should be focused on growing incomes, not redistributing incomes. It should be focused on creating opportunities for workers and families to raise their living standards and achieve their dreams. A sound tax system should be about making the US more competitive and dynamic. And tax policy really should be about simplifying the tax code, not making it more complex. You know, as former Majority Leader Dick Armey used to say, we need a tax code we can respect and a tax code that respects us. Well, last fall, we released a 10-point tax plan to achieve those very goals. The plan greatly simplifies the tax code for both business and individual taxpayers. It would boost capital investment and maintain our competitive stature in the global environment. It would also improve supply chains and improve domestic productivity. It would offer every family universal savings accounts so that they could save for the future and build family wealth. Now, as good as this plan is, and we think it's pretty good, it just really tinkers around the edges of the existing tax system. We wanted to think bigger. For nearly a decade now, we've produced our International Tax Competitiveness Index. And this index ranks the quality and competitiveness of the tax systems of the 37 OECD nations. Well, needless to say, the US doesn't rank very well on our own index. Typically in a year, we're usually around 25 or 26 or 27th on the list due to the machinations of the tax code. However, one country has ranked first and best on every edition of our international index, Estonia. And as you will hear, Estonia has a nearly perfect, neutral, and pro-growth tax system. It rewards capital investment. It doesn't tax or double tax business income. Everyone pays the same low flat tax rate. So we thought, what would it take to transform the uncompetitive US tax system to the #1 Estonian tax system? And what would that do to growth and opportunity in the US? You're about to find out. I'm pleased to be joined today by my colleague, Will McBride, our Vice President for Federal Tax Policy and the Stephen J. Enton Fellow in Economics. And we'll be presenting the results of our plan with our team members, Erica York and Garrett Watson. Erica is Senior Economist and Research Manager, and Garrett is Senior Policy Analyst and Modeling Manager. But before we get to that, we're really pleased to be joined by our good friend, Helen Pahapel, who is Tax Policy Advisor at the Estonian Ministry of Finance. And I should mention that Helen is joining us from Tallinn. And if none of you have ever been to Tallinn, I really encourage you to put it on your bucket list of places to visit. A beautiful city, wonderful to tour and visit. So I encourage everyone to go to Tallinn whenever you get the next chance. And Will and Helen will give us an overview of the Estonian tax system. Now, here's some quick housekeeping items before we get started. The webinar is recorded, and the recording will be released after the event is finished. And all of you are muted. Not that we don't love you, but we've muted all the attendees. And also, if you have any questions, please use the Q&A button below and include your name and your organization for our information. And if you have anybody in particular you'd like to direct the question to, please encourage that as well. So with that as our foundation here, we'll get the program started. And Will, I'm going to turn the program over to you, and the floor is yours.
Okay, thanks a lot, Scott. I agree with those remarks, and I also have been to Estonia and fully endorse it as a great place to visit, and a very very nice bunch of people, including our guest here, Helen, who I'm going to turn it over to in just a few minutes, in about 5 minutes. So the wonderful thing about the Estonian income tax system is that it can be explained in about 5 minutes, which is all the time I have. When looking at the Estonian tax system, it is very clear that the overarching theme is simplicity. A distinctive feature is the distributive profits tax paid by all businesses. Instead of a corporate income tax, which requires businesses to calculate taxable income, accounting for all sorts of deductible expenses, depreciation, amortization, limitations on those deductions, various exclusions, exemptions, and credits, and especially complex rules for foreign income, Estonian companies pay a tax of 20% on distributed profits, including dividends and net share repurchases. That is, retained earnings are exempt from tax. So if a company, say a startup, is growing fast, and to keep growing fast, it needs to reinvest all of its earnings in the business, say by raising wages, hiring, and buying new equipment, the company can do that without paying the 20% tax on those earnings. And for the most part, the tax only applies to profit distributions from domestic companies. So profits earned abroad are generally only subject to taxes that apply in those jurisdictions. Now, the relative simplicity of this business tax system and its pro-growth potential should be readily apparent to business owners, decision makers, and all those who have had to file a corporate income tax return or partnership return or various other types of business tax returns and forms we have in this country. As we discussed in our paper, and we'll cover to some extent later in today's program, the time and cost it saves businesses is substantial, as are the broader benefits to the economy. Regarding taxes that apply to individual income in Estonia, it is much like our current system, but far simpler. Instead of a progressive structure with multiple brackets and rates, along with dozens of deductions, credits, exemptions, and other preferences, it is a flat tax of 20%, matching the rate on distributed profits. There is a personal exemption and a small number of preferences available, but relative to our system, it is straightforward and simple. So simple, in fact, that it typically takes about 5 minutes for individuals to file their taxes. As difficult as that may be to believe, Helen will talk more about that in a minute. To prevent the double taxation of corporate income, dividends paid to shareholders are exempt from individual income tax, since they are already taxed at 20% through the distributed profits tax. Capital gains are taxed as ordinary income, also at 20%. The single rate on all income takes away a lot of the arbitrage and tax planning opportunities that are available in our system, making for a relatively transparent tax system that is understandable and comprehensible by taxpayers, administrators, as well as policymakers and other stakeholders. Is this a high tax system or a low tax system? Based on tax revenue collections, the Estonian income tax system is about on par with other developed countries. It collects sufficient revenue with a relatively low tax rate because the tax base is broad. For instance, all employee compensation, including wages and fringe benefits, is subject to income tax and payroll tax, in contrast to our system that exempts fringe benefits entirely from tax. One last thing to note, as one might expect, the Estonian tax system takes a simple approach to taxes at death. Instead of an estate tax like we have, which involves a complicated process of estate valuation and a high tax rate of 40% on the taxable estate, in Estonia, death is not a taxable event. Rather, assets that are bequeathed are given capital gains treatment with a zero basis. So when realized, that is, sold by the heir, the capital gains tax applies with a deductible basis determined only by costs incurred by the heir. Overall, it is a remarkably simple approach to taxing income and estates, which generates sufficient tax revenue without the complexity, confusion, and controversy that ours does. To discuss the reality of the Estonian approach in more detail, let's hear from an Estonian. Helen, you have served in the Estonian tax ministry for many years and now serve as an advisor there. Curious what your experience has been. Let's start with the effects on taxpayers. First, is it true that it takes 5 minutes to file taxes in Estonia? And if that's true, how do you do it?
Good afternoon, everyone. Happy to join this webinar. Well, it does take 5 minutes, sometimes even less. While I was preparing my presentation for today, I remembered I hadn't submitted my tax return yet, so I just did it in less than 5 minutes. So for me, it's done for the previous year. And now what remains is to wait for the refund. So that's probably one of the reasons that Estonians really love their tax administration, because most of us get some sort of a refund each year. But I will now concentrate on the compliance and administration issues, and I have prepared some slides, which I cannot see myself at the moment, but now they are in front of you. Few words about Estonia first. We are a very small country in the northeastern Europe and have been independent from the Soviet Union a little over 30 years. So we had the possibility for a fresh start in the beginning of 90s. And although we received a lot of assistance from the US, from OECD and the EU countries, we realized pretty quickly that we had to stand on our own and manage with our tax system and the administration of the country ourselves. There are about 1.3 million people in Estonia, and naturally not everyone can work with taxes. So we have to be very efficient. And at the same time, we have always strived to be very competitive. We don't have too many natural resources. So the path that was chosen already in the beginning of 90s was that we were going to provide a favorable business environment in order to attract foreign investment. So in 1994 already, our Prime Minister at that time chose the path that Estonia must have a very simple tax system, which means that the tax base should be broad and only with a limited number of exceptions. That would, in his opinion, help to keep the administrative burden low, both for the tax administration and also the taxpayers. And it has worked. As from the year 2000, when I also started to work for the Ministry of Finance, and that's also the year when the new corporate income tax system became effective, our tax administration has invested a lot into automated digital solutions. Of course, the possibilities in the early 2000s were much more limited than they are now. But what we have noticed is that simple and functional tax system also enables to use automated digital solutions, and that in turn would also result in considerable savings in compliance costs. And like Will already said, and I personally confirm, if you're an individual in Estonia, with what we say regular activities, you have an employer, you may have some limited amount of deductions, maybe you have a mortgage, some capital gains, it will take you a very little time to file your tax return. And the same is true for companies. And I'm referring to World Bank data here, where it was measured that an average Estonian company is spending 50 hours per year for preparing tax returns and paying taxes. I also added a fun fact here that it takes about 5 minutes or perhaps 15 to set up a limited liability company online in Estonia. What we shouldn't forget that Estonia is a EU member state, and unfortunately a lot of administrative burden comes in the form of several other bureaucratic requirements. And at least we do not add the burden of, tax compliance on top of it. And at the moment, we have about 200,000 registered companies. And sometimes we joke that almost every Estonian has a company, because many people do use them for managing their personal assets and holdings. And many people just create a company just because they can. Whether this is a good thing or not is probably up to a person who is, looking at it, because our tax administration doesn't really like the empty companies, but sometimes, just because. We also have a very favorable environment for the startups, and I think we have the highest number of startups per capita in Estonia, and also probably the highest number of unicorns per capita. So we are proud of our tax system. It's not the only thing that is good in Estonia, of course, and the companies need a good infrastructure and good legislative environment, but we definitely believe that our corporate income tax and also personal income tax have contributed to our success. Next slide, please. I really like this citation by our head of tax for PwC in Estonia, and it sort of sums up our tax system, that hardly any Estonian businesses use external advice when they submit tax returns. It doesn't mean that the tax advisors are without any work in Estonia. In case of mergers and acquisitions, there are some things that you would seek a professional tax advice then. And funnily enough, fringe benefits. Our tax administration gets a lot of questions about fringe benefits, and it might be because there aren't too many more important questions to solve, and therefore the accountants often want to make certain whether the flowers they give to the employees are fringe benefits or not. But these are pretty trivial questions, but it shows you that if you don't have more important things to ask, you need to do something, you ask about fringe benefits. And of course, we have the transfer pricing rules, and also some tax advice is sometimes needed with the VAT. I also added this fact here that we do spend very little for collecting our taxes, and this the second bullet point is taken from the OECD's publication. And I also put a reference somewhere, but that's from year 2020. I tried to access the 2022 report, but I couldn't. But in comparison with France, for example, we spend twice as little for collecting 100 euros. So, and the amount has been lower, but we consider it to be quite a reasonable amount to spend for collecting the taxes. Could we have the next slide, please? As you can see, the will to pay taxes is pretty high in Estonia. It hasn't always been so, but our tax administration has worked very hard in explaining why the taxes should be paid. They have had several successful campaigns, and it also has delivered results. They also have an approach that they should make paying taxes very simple, so it would be a pleasant experience. And therefore, taxes paid rather than collected is something that they are striving for. And if we could have the next slide, that I have actually copied from our tax administration's presentation, then here you can also see what they are really stressing. Of course, the simple tax system is something that is really important to increase the compliance. Then again, the tax administration has invested heavily in their image as a government institution that is providing customer service instead of being a police-like institution. And indeed, they have been quite successful. And Estonians do believe that they pay a fair amount of taxes. Of course, not everyone, but most of us. If we could have the next slide, please. Here, again, from the tax administration's slide collection, it shows the communication channels that are being used by customers or taxpayers when accessing the tax administration or asking a question. And you can see that 99% of the businesses are doing everything via electronic channels, and 96% of the private individuals are also mostly using the self-service. Tax administration's web page is widely used, and most people get their answers from there. So service office is frequented just about 1% of people. And of course, we cannot call it the call center, but there are people who are answering the phone. So if you can't find your answer on the web page, you can just pick up the phone and call them, and you will get a very quick service. I once got a complaint by one taxpayer who said, I have been waiting, for so long for the tax administration to pick up the phone that I won't pay my taxes. And then we looked into it, and he had been waiting for 1 minute, twice. And that was already testing his patience. So in the end, they called him back, and he got his answers and hopefully paid his taxes as well. If we could move on to the next slide. I put it there just to illustrate how we can pay or submit our tax return in 3 minutes. And the reason is that most of our return is already pre-filled. So we just have to check whether the information is correct, then press the button send. And if everything is also correct from the tax administration's perspective, we either get our refund or a notice that more tax needs to be paid. So that's how we get to 3 or 5 minutes. And the next slide, please. Here, I just put it here to show you the percentage of the population that works for the tax administration. Since our population is really small, we have a small number of people in the tax and customs board, but still it's not the lowest percentage of the population naturally, but we think we're still doing pretty well. And now we are getting to the final slide that shows how much the public actually trusts the tax administration. And there is an independent non-governmental institution that conducts the studies every year or even more often. And for the last quarter of the year 2022, the tax administration came out as the fourth out of 26 government institutions whom the people really trust. And the first ones were directly life-saving institutions like the police, the call center where you call, like our equivalent to 911, and then the fire squad. So I spoke with the head of our tax administration yesterday, and he said we basically disregard, the police, because people know they can't live without the police and 911. So we consider ourselves to be the first. And the defense forces are right behind the tax administration. So all the investment into this good customer service has certainly paid off. Thank you.
Helen, that was great. Still somewhat hard to believe in the context of, we're in tax season now in the US, and I personally have not tried to call the IRS for my tax situation, but I understand it's very frustrating process for those that do. Only about 10% of the millions of calls to the IRS are answered these days, which is very, very different from the Estonian experience. So we have a couple of questions from the audience. I think there's one related to Pillar 2, which is the global minimum tax that's being negotiated and proposed in the EU and model rules developed by the OECD. I know you've had a lot of interaction there and a lot of experience with it. There's a question about how it applies to Estonian companies, how it might apply. This is all somewhat speculative, as it's not legislation anywhere yet, or at least it's not in force. And so can you tell us about your thoughts there, and I guess more broadly how being a competitive, having a relatively competitive tax system in Europe, how does that how does that affect your relationship with the other countries in Europe and the EU?
Well, this is now the subject that we could have a separate several hours webinar on it, but we did manage to achieve a sort of delay period for our corporate income tax under the minimum tax rules, meaning that if the Estonian company doesn't distribute in year one and doesn't pay any tax, then the country where the ultimate parent entity is situated would have to wait for 4 years before they apply their income inclusion rule and top-up tax. But very broadly, companies in Estonia have the opportunity to decide how much tax they pay. So in order not to activate the UTPR and the IIR, the company can actually, they can calculate their globe tax base and based on that, decide how much profits they would need to distribute. Will was correct in saying that we don't have any legislation in place yet for dealing with the effects of the minimum tax, but what we're going to do definitely is we are trying to maintain our business-friendly environment. And at the same time, we don't want to force any companies to distribute. So we are probably going to figure out the system where the companies have the opportunity to pay the tax in order to bring their effective tax rate up to 15% without distributing. But again, that's something that lies ahead. And we also got a sort of option to delay the application of IIR and UTPR ourselves in the EU directive, which indeed means that the other countries could use the UTPR, so to say, against the subsidiaries located in Estonia unless they distribute. But also the 4-year rule has to be respected there. So we have never hidden the fact that we are not the fans of Pillar 2, and we will have a new government very soon, and we'll see what they will decide, of course, based on our recommendations. But we do hope that we manage to keep our competitiveness. We really worked very hard for achieving the results that we have in the OECD statement and also in the EU directive.
Great, interesting. So you're basically describing, we've gone from simple to very complex, as we can see, talking about these external
I think we may have lost Will. See if we can get him on here in a moment.
Sorry about that. Yeah, we're going to try to get Will back.
I think I can just take one more question if we have time. Do we?
Yes, please go ahead, Helen.
I'll take the last one for the moment. Yes, we do have VAT, and the standard rate is also 20%. There are, again, only very limited number of exceptions: medicines, medical services, books, accommodation, now also journalism. What you would call payroll tax, I would assume it's something that we call a social tax. And that's pretty high in Estonia. It's 33%, and it's payable only by the employer. So we as employees cannot be held responsible for it. And the social tax actually amounts to it's the biggest part of our tax revenue, but it's something that we call a transferable tax, because 20% of it goes for paying out the current pensions, and 13% goes into more or less general health insurance that most of Estonians have.
Well, there's another question here about computing the profits, and maybe this is a little more detailed than we had initially covered, but asking if how you compute those distributed profits. Is interest deductible, depreciation, those kind of things? You mentioned if someone owns a home or has a mortgage, how is that handled as well?
If I see the question business profit, I would automatically think we are talking about companies here, which is, the most common form you would choose when you're doing business. We only have what we call financial accounting. We don't have any separate tax accounting. So the profits that the company can distribute are the ones that you see in your profit and loss account. Something that you would probably call profit after tax. But since we don't apply the corporate income tax on a yearly basis, then it's just, your net profits. This is what you can distribute, and the tax is applied to the amount that you actually do distribute. So interest is deductible, and depreciation in your financial accounting as well, but no accelerated depreciation. Thank you.
Well, because you effectively have immediate expensing if you don't have to distribute profits, or you don't have to, if you can withhold your profits as long as possible. Will, I see you're back.
Yeah, I'm back. Sorry about that. We don't have very reliable Wi-Fi apparently in the office. So sorry about that. So, and we're at the end of our time with Helen. Helen, thank you very much. This has been kind of shocking, I think, for a lot of U.S. taxpayers. Probably
Pleasantly surprising.
a pleasant surprise. Yeah, but thank you. It's been very informative, and we hope to see you again soon.
Thank you.
Okay, take care.
And
We will now turn to the next part of our program here. We're going to discuss the U.S. context in more detail, particularly asking us all to imagine, if you will, what it would look like if the U.S. had a tax system like Estonia's. Joining me to discuss our analysis and modeling of the results of such a reform in terms of the impacts on taxpayer compliance costs, the economy, the federal budget, and the distribution of the tax burden are Erica York and Garrett Watson. Garrett, turning to you first, if you can give us a brief rundown of the key components of this reform as we modeled it in the U.S. and discuss some of the benefits of simplifying the federal tax code.
For sure. I think, Tyler, if you have bring up the slides, perfect. So we'll run through some of the high-level overview that, of course, you can find more information on our modeling paper that came out earlier this week on all the details here. But we wanted to run through this briefly. If you go to the next slide, we want to cover sort of at the high level what we're doing here in the plan to bring to life what this reform would look like in the U.S. context. So at a high level, the plan is revenue neutral. That's something that we tried to do over the 10-year window. It was a pretty big priority, and we'll go into the specifics of the revenue change here in a little bit, and consists of sort of three large pillars, if you will, in terms of reforms to the U.S. tax system. The first, as you can see here, and was alluded to by Will a little earlier, was implementing and reforming the individual income tax toward a flat tax of 20%. And that has a lot of moving parts in order to balance revenue and distribution, as well as economic growth and simplicity. So one major part of it is combining that 20% rate with a generous family allowance that is a combination of an expansion of the standard deduction and the personal exemption, bringing that back, as well as making permanent a more stable version of the child tax credit, details of which are in our paper, as well as preserving the tax preferred savings accounts that exist under current law. But of course, the trade-off there is that will have a revenue effect and a distributional effect that we wanted to offset. And we did so, of course, in the way that is typically seen as most economically efficient, which is through base broadening. So we eliminated most credits, deductions, and other preferences in the individual tax code that amounted to over combined $8 trillion worth of revenue over 10 years, a tax base of which, of course, is much larger. So that includes major items like the itemized deduction for mortgage interests, the itemized deduction for state and local taxes paid, the deduction for charitable contributions, other exclusions for capital gains on principal residences, and a variety of posts, a raft of smaller exclusions in tax expenditures, including various credits for preferred activity for businesses, various deductions on the individual side, just to clean up and simplify the code as much as possible. So that's the first plank. If you move to the next slide, the two other pillars that were major, the second of which was discussed in a lot of detail by Helen and Will, which was the distributed profits tax of 20% that would replace the current complicated regime of taxing domestic businesses, taxing domestic foreign profits, as well as pass-through firms. And one thing that's worth mentioning is that it equalizes the treatment of pass-through firms and C corporations in the US, which is another simplifying element to this reform. And the third one that Will also mentioned, of course, was the elimination of various taxes at death, including the estate tax and the gift tax that's goes along with it, as well as the general simplified treatment of capital gains at 20%, along with the ordinary income tax overall, to help relieve that burden of unnecessary compliance costs. Speaking of which, one major item we want to cover before getting into the modeling results, if you go to the next slide, was, I think actually, yeah, you can just leave it here, before getting into the economic results, was the administrative and compliance savings that we find when moving to this plan. Because we do anticipate, as Will mentioned, that the tax reform plan would lead to significant reductions in administrative compliance and efficiency costs overall. And the burden overall, of course, of complying with the existing tax code is pretty staggering. It consumes, by one estimate, about 6.5 billion hours in cost, totaling about $313 billion every year. That's equal to over almost 1.5% of GDP. So we expect, by simplifying the federal tax code, both on the individual side and for businesses, this reform would substantially reduce those compliance costs over and above what we're estimating in our modeling. So this is actually separate from that, but we're pretty confident there would be significant savings here, saving taxpayers up to or even more than $100 billion annually. That includes $70 billion in reduced compliance costs for businesses and $30 billion in reduced compliance costs for individuals related to both individual income returns as well as their estate tax returns. For example, the various costs of complying with the various complicated depreciation and amortization forms that exist under current law would be eliminated. That's estimated at $24 billion in costs. The costs related to the very complicated deduction for qualified business income that exists under current law through the end of 2025 would be eliminated. That's about an $18 billion savings, and replaced, of course, with a 20% distributed profits tax. And much of the compliance costs associated with the variety of other forms, including Form 1120 and the other business income tax returns, would also be eliminated, and that's estimated at costing more than $60 billion right now. To put this in individual terms, as many of you know on this call, it currently takes about 12 hours on average for U.S. taxpayers to comply with the current individual income tax code. And so the annual aggregate compliance costs total somewhere between that $75 and $100 billion range. And that really contrasts with what Helen was describing to us, which, of course, basing it on the Estonian experience, where it takes only a few minutes to comply for many taxpayers. So you'd see a large reduction in compliance costs there overall. As Helen mentioned, the administrative compliance costs on moving toward the business tax system, similar to Estonia, would bring us closer to the lowest in the developed world, which is also very helpful, I think, for small businesses and entrepreneurs, startups, and folks that are really responsible for driving U.S. economic dynamism and often are disproportionately impacted by the complexity in the existing tax code. So I want to give that sort of review of the compliance and administrative effects before diving into the modeling. So in addition to this, of course, we used our in-house taxes and growth model to understand quantitatively how these reforms would impact the U.S. economy, would impact federal revenue, and the distribution of the tax burden as well. So I'll pass it over to Erica, who will next cover what we discovered on the plan's impact on the U.S. economy.
Yeah, thanks, Garrett. So while filing taxes in 3 minutes sounds like a dream, especially to me, as I have not filed my tax return yet this year, that's arguably not even the best part of the Estonian tax system. As we've talked about so far, the most important and competitive part of Estonia's tax system is that it's neutrally structured, and so it does not discourage saving and investment, particularly by correctly defining business income and eliminating the existing biases against saving and investment that are inherent in the U.S. tax system today. We estimate that the reform that Garrett previewed would boost U.S. investment and growth. Specifically, using our in-house model, we estimate it would increase long-run GDP by 2.3%, increase the long-run capital stock by 3%, raise wages by 1.3%, and add 1.3 million full-time equivalent jobs. So to put that in dollar terms, using 2023 dollars, the increase in economic output would amount to about $400 billion by 2032, the end of the budget window that we modeled this plan under, and in the long run amount to $1 trillion in additional economic output on an annual basis. The long-run capital stock change would amount to about a $2.1 trillion increase in 2023 dollars in the long run. And then to set this overall economic effect in context, if we compare it to what we estimated the 2017 tax reform, the Tax Cuts and Jobs Act would do, we estimated that would increase long-run GDP by 1.7% and add 339,000 full-time equivalent jobs. And of course, that came with a relatively large revenue cost in the 10-year budget window. So in comparison, the reform that we have outlined here would have significantly larger positive economic effects and is also done in a more revenue neutral basis. So we can advance the slide. And the two major changes that drive the economic results, the table here breaks it down by provision in the plan. First is the replacement of the current progressive income tax structure that we have now with a 20% flat tax on individual income. We estimate that particular aspect of the plan raises GDP by 1.3% and adds 1.2 million full-time equivalent jobs. The other major driver here, of course, is the replacement of our current business income taxes. So looking at both the corporate side and the pass-through side with the 20% distributed profits tax. And under that, since profits are defined as the cash that's distributed to shareholders, the tax base really has no concept of depreciation. So under that reform, businesses don't need to delay the recovery of their investment costs for years or decades like they do under the US system currently. And as such, the distributed profits aspect of the reform raises GDP by 1.7%. and adds 412,000 full-time equivalent jobs. So those are the two main drivers of that long-run economic effect. We do see in the table the base broadeners that Garrett mentioned subtract from that somewhat, resulting in this net impact of 2.3% increase in economic output in the long run. And with that, I can turn it back over to Garrett to discuss in detail our revenue estimates.
Thanks, Erica. Yeah, so here on the slides is a review of our overall revenue effects. Lots of numbers here, but of course, at the very bottom, you can see after dividing up the changes by individual provisions, business provisions, provisions for the estate tax and related taxes of death, we come to our total sort of conventional revenue. We estimated this over 10 years. And of course, we did want to strike the right balance where we're trying to create a sustainable pro-growth reform to the US tax system that also ensures that the US is meeting its revenue needs. And so as you can see here on a conventional basis, we estimate that the reform overall would raise within the window over the next 10 years from 2023 to 2032 about $334 billion relative to the baseline. And as you'll notice here, and without getting too much into the weeds here on budget scoring, but we did this relative to current law as we do with all of our scoring, and it's consistent with the way it's done by major scorers in Washington. And so there is a lot of interaction, of course, between the first few years where the 2017 tax law is still in full effect and the back half of the window post 2025 when the tax code will shift pretty radically under current law, assuming nothing is done. And so that explains the pattern that you're seeing, where we raise about $600 billion in the first 3 years, during which those the baseline's reflecting those individual provisions, and then we see a slight revenue loss every year post 2025 on a conventional basis. Though I think it's very much a manageable amount there, and well within the potential sort of window of uncertainty as it relates to the revenue effects. The other thing that's worth mentioning is we also provide the dynamic revenue over 10 years, which we find would raise about $173 billion over the budget window. And so part of this reduction relative to our conventional score is due to some of that smaller revenue gain, as you'll notice in the first few years. And that's related to the interaction of the economic effects of some of the base broadening relative to sort of the tax increases over those few years. And so that creates an interesting pattern where overall, you see a reduction in dynamic revenue in the first few years, but the gap actually very quickly closes, particularly after 2025. And we actually see a very slight revenue increase on a dynamic basis by 2032 overall due to that larger economy and the correspondingly higher income and payroll tax revenue that we find overall. The other interesting point to keep in context when it comes to revenue is how this would impact sort of the overall fiscal trajectory of the US. We did aim to, of course, make the plan sustainable relative to the current law baseline, but of course we still have structural deficits and a debt challenge over and above that will have to be dealt with. But overall, this plan would help on a dynamic basis. We find that the larger economy and the resulting net revenue increase would reduce the overall debt to GDP ratio as measured in the baseline by CBO of about 250% in 2063, about 40 years out, to 243.7%. So that's a reduction of nearly 6 percentage points in the debt to GDP ratio 40 years hence from adopting this plan. Though, of course, there's a lot more work to be done on the revenue side for the US to keep us in a sustainable revenue situation and a fiscal situation. So lots of individual items here. If folks have questions, we of course can go into that in a little more detail. But wanted to hand it over to Erica to chat more about our distributional impacts.
Thanks, Garrett. So over the long run, on an average basis, taxpayers would see an increase in after-tax income by about 0.3% conventionally. The bottom quintile would see a 0.7% increase in after-tax income, and the second quintile 1.1% increase. And those increases are mostly explained by the expanded standard deduction, personal exemption, and a permanent child tax credit. Taxpayers in the middle and upper middle quintiles would see a decrease in after-tax income, and that's largely driven by the base broadeners within the reform that offset the reduced rate and the expanded family-related provisions. And the top 1% of earners would see a 15.9% increase in after-tax income. And again, that's largely driven by the rate reduction. On a long-run dynamic basis, the larger economy increases after-tax incomes relative to the conventional analysis, resulting in a 2.1% increase in after-tax income on average. And so that increases the gains seen by the bottom and second quintiles, and it offsets some of that negative impact on the middle and upper middle quintiles. Their reductions are smaller on a dynamic basis compared to the conventional estimates. One factor to highlight here is that the distributional analysis doesn't factor in the compliance savings for individuals, which would be another important factor because the simplicity afforded by the system will result in both time savings and cost savings, a reduction in direct costs that people incur across the income spectrum. And then a final note here is that though after-tax incomes increase on average, really in any revenue neutral tax reform that you have, a tax reduction for one group of taxpayers necessitates a tax increase for another group of taxpayers. So when you're doing this on a revenue neutral basis, it does alter the distribution of the tax burden. But if you alter various aspects within the plan, you could achieve different distributional results. And so that's one thing to note, that different aspects of the plan could be tinkered with to change this with, of course, economic and revenue trade-offs, depending how you did that. And I think that saves us a little bit of time for Q&A. Will, if I'll turn it back over to you.
Yeah, sure. There were a couple of questions about the progressivity and the distribution of the tax burden under this reform. I think that your remarks covered that, Erica. And there's a question about who do we contact to learn more? Well, you can contact any of us. We have a phone number. It's on our website, and that will be directed to someone on our federal tax team here to discuss these issues. But there's several questions about it, sort of administrative issues that come up with any reform like this. It's this is not wave a magic wand and it's all works out, and there's nothing nothing needed beyond that. There's always several months and years of really regulatory guidance and adjustments that are required in any major tax reform, and those would be addressed at that time. But maybe just following on that, if Garrett and Erica, you could each talk about the sort of the transition path, what some of those issues that come up in any kind of reform, and how that might be dealt with.
Yeah.
Go ahead, Erica.
On the business side, of course, there would need to be some sort of transition discussion about what do you do with existing like net operating loss deductions, existing depreciation deductions that companies are currently taking, and would you provide a way for those essentially tax assets to be used and recognized in the transition to the distributed profits tax. Of course, as you offer transition relief, that costs revenue, and so things like a higher rate may be needed to maintain revenue neutrality, and that of course reduces the efficiency gains of the plan. So important trade-offs to think about as you potentially offer transition relief for things like that.
Garrett, I don't know if you have any comments.
I think that sums it up. And I think we saw that with other tax reforms in the past, where that was a focus on transition relief and making sure that folks felt comfortable with what was ultimately decided to get you to the long run result. So definitely a lot of work to be done there. And thankfully, I think we can learn from tax reforms in other countries, including in Estonia and elsewhere, that have made changes in the last 30 years in their tax systems to understand what that right balance is.
Sure. Well, let's dig into some more of these questions if we can. So there's sort of a few questions that have to do more with Estonia, how they do this, and I guess there's a question about how realistic it is. I think hopefully you believe that it's a real place that actually has this system in place. It's actually been in place for 22 years since 2000. Before that time, they had a income tax system much like ours, corporate income tax system. And a personal income tax system. So they made the switch and they've stuck with it. So it does have some stability, clearly, and I think Helen demonstrated it's got there's coming, along with that is a high degree of sort of happiness. I don't know how else to describe it. Happiness, satisfaction with the system. Apparently, we don't have time to get into if there's been any sort of efforts to change the system substantially, but the outcome clearly is that it has not changed substantially. The rate came down as part of the original reform 22 years ago. It started at the old top tax rate of 26%, and that came down in stages to 20%. But the structure of the tax has been in place and for 22 years and has not substantially changed. And there's questions about, so how are things done on the spending side, if there's family allowances there, and I believe there are. This is not something we really spent a lot of time researching ourselves. We focused on the tax system, but in general, in Europe, much of the social spending occurs on the spending side. It's not mixed into their tax codes like it is in the U.S. Certainly not to the degree that it is in the U.S. And now with that, I think we have a couple minutes just to have maybe our panelists here, Erica and Garrett, talk about final thoughts, wrapping up, sort of conclusions about this reform in the U.S., the trade-offs involved, and your thoughts on it. Erica, let's start with you.
Yeah, I don't think the appetite in the U.S. is there for a full-fledged reform at the moment, but maybe as we get closer to the TCJA expirations and as lawmakers have to deal with the major impending tax increases on individuals that are built into current law, hopefully we have a productive conversation about addressing the tax system and the continual expirations and quick kind of reforms that we've seen over the past decades, and moving towards a cash flow type system like Estonia has, and a much simplified individual income tax system is hopefully part of the conversation. Hopefully our research here shows lawmakers and policymakers and the thought community the benefits of moving to this, both in terms of economic benefits as well as the compliance and administrative benefits.
Yeah, I would echo a lot of what Erica just said. I would, of course, note many folks are aware that big picture tax reform is often something years or even decades in the making when you trace back the thought leadership and the evolution of ideas, both from what culminated in the tax ideas the last 2 years from folks amongst Democrats and others, and then what was going on with Republicans with the Tax Cuts and Jobs Act, going back to the Camp draft and even before that. So this is very much a long lead time, and a lot of I think we need to tackle directly the tough questions related to the trade-offs on distribution and the economic impacts. And I think this is a novel contribution toward advancing that conversation, because a lot of the discussion has been on more incremental changes. We need to think bigger, and I think this is a first step toward trying to quantify what that may look like.
That's great. I think that sums it up well. It's sort of reality-based policy analysis. We get to observe the system in another country for several years, and as we've done in our paper, noting those studies that have looked at Estonia and then our analysis of the system if it were put in place in the U.S. I encourage you to check out the paper, and thank you all for joining us. Thank all of our panelists, and particularly thanks to Helen providing such great insight and stories about the Estonian system, and I hope we've all learned a lot. And if you'd like to learn more, as I mentioned, please reach out to us at Tax Foundation at our website at taxfoundation.org. And I believe we will have these slides available at some point upon request. So with that, I'll let everyone go, and thanks for your time, and take care. Bye-bye.